Hello from New York. In the spirit of Halloween and also to mark the end of QE, which has bequeathed a period of zombie-like markets, we're here to talk about this week's meeting of the Federal Reserve.
Right.
That's really hot.
Mike, you went with the zombie markets analogy. I was going to go with the LSAPs are dead, but their legacy continues to haunt us analogy. Both analogies are great, and by great, I mean super tortured and not really all that useful. But it's such a fun topic that
I think it's worth I think it's quite appropriate, actually. The Fed has its meeting in the same week as Halloween. So let's unpack QE. What's it really done for markets?
Hard to say, and I think the efficacy of QE3 is something that's going to be debated for a very long time. Remember that it was very different from the first iterations of QE. QE1 was part of a broader credit easing strategy. QE2 wasn't open-ended the way QE3 was. It had a very precise and preordained amount of assets that they were going to buy under that program. QE3 was the first time that Bernanke essentially said, listen, I'm going to do this until the economy's better. Okay, and he defined the justification for QE3 as follows: an improvement in the outlook for the labor market. It's really kind of hard to say that that hasn't happened. The pace of monthly jobs growth is much better now than it was. It has been much better for the last 12 months than it was in previous years. How much of that you can credit to quantitative easing versus the end of fiscal drag versus other parts of Federal Reserve communications policy versus just the economy organically getting back to normal is really hard to say. It's going to be a controversial point for a very long time.
Yeah, and I think one of the missing elements for the labor market recoveries to date has been the absence of strong wage gains.
Yeah, for
and
sure.
Also the mix of new jobs that have been created. We've seen a big drop in labor participation. So yes, I think it's going to remain a very controversial topic. But it does seem, when you look at today's policy statement, that the Fed is a lot more optimistic about the labor market and is almost kind of pushing itself towards saying to the markets, look, rate hikes are going to come.
The really interesting new language, I think, was what our man in Washington, Robin Harding, called the get-out clause, which is a new part of the statement that said that any decision on rate hikes is going to be tied to the pace of progress towards the Fed's objectives. It's not going to be defined by considerable time, and it's not going to be defined by specific markers of progress. In other words, the pace of progress matters here too. The problem here is that we don't know what considerable time means. So what does it mean to say that rate hikes are going to come sooner if progress is faster? If we don't know when rate hikes were going to happen anyways, what does it mean to say that they're going to come sooner then? Does that mean 6 months? Does it mean 9 months? That's really still kind of hard to interpret. And so I think there's a possibility that in the next meeting they're going to further clarify that they might even replace the considerable time language with a more clearly defined reaction function.
That does seem to be the conclusion that many in the market are drawing today.
Sure.
We've sort of seen the dollar pick up. We've seen rate hike expectations start to be pulled forward a little bit. We've seen stocks come under a little bit of pressure. So it does seem the Fed's effort here to kind of wean off some of the excesses in credit markets is working, but they are treading a fine line here, because a stronger dollar over time will tighten financial conditions, and we really have to see oil prices stabilize here.
Surprising part of the statement that they sort of disregarded it. Now, obviously, oil prices, energy prices affect headline inflation directly. They don't affect core inflation directly, but there's always a chance that it's going to have a pass-through effect. Right? I think this is something that a lot of Wall Street economists are starting to study now, is precisely how big that impact would be. It's really hard to say, but it probably at some margin is going to have some kind of an impact, and the decline in oil has been really quite impressive. A lot of people are even saying now that if the decline in inflation and inflation expectation sticks for long enough, that eventually we might have a new round of quantitative easing, right? If it's necessary. This statement seemed to not even take that into consideration, right? That still seems to be,
I think the statement's trying to put clear water between the era of QE, get markets away from their sort of zombie-like, dead-like status state where they're sort of relying endlessly on this kind of central bank put, and sort of normalize things as quickly as possible.
They were trying to maintain as much flexibility as possible was sort of the interpretation I got. Those on the committee yelling, they were trying to keep an open mind about what happens next, and they weren't trying to pinpoint anything specific.
Let's see how long it continues, how markets react over the next few days. Obviously data dependent, so now the focus will turn to the upcoming employment report due the first week of November, which is next week, of course, and whether or not we need to pull out the zombie masks again.
Let's hope not. All right, thanks.